Welcome to this explainer. Okay, let's dive right into what I like to call the financial gray area. It's a fascinating, often perplexing space where capital instruments completely blur the strict lines between debt and equity. We're really talking about the chameleons of the balance sheet here. These are instruments that start their life looking like a standard loan or a simple contract, but they hold the power to suddenly transform into equity at a moment's notice. Or we're talking about entirely different structures where traditional equity simply doesn't even exist. So why is this borderland so exciting and honestly so dangerous? Because in the complex world of finance, getting the label wrong on just one of these chameleons can completely rewrite a company's reality overnight.
So, here's our roadmap for today. First, convertibles and the single unit fix. Then, warrants and the SPAC crisis. Third, handling non-controlling interests. Fourth, partnerships and accounting without shares. And finally, conclusion, why classification is king.
So what happens when debt acts like equity? Well, frankly, it's the ultimate accounting headache. As we're going to see throughout this explainer, getting the classification wrong on these instruments isn't just some minor administrative typo. Misclassifying these hybrids can severely distort earnings and trigger massive historical restatements, literally wiping out billions in paper value overnight sometimes, and cost a company millions in audit and legal fees just to untangle the mess. It's a high-stakes environment where one tiny wrong interpretation of a contract can derail an otherwise perfectly healthy business.
All right, part one, convertibles, the single unit fix.
Let's kick things off with convertible debt. Under the old US GAAP rules, if a company issued a note that could convert to shares, accountants had to forcefully split it into two separate pieces, debt and equity. They basically carved out the equity conversion feature and parked it in additional paid-in capital. That created a massive discount on the debt side, which then had to be amortized over time. The result? Companies were forced to report millions of dollars in non-cash phantom interest expense every single quarter. It was ruthlessly dragging down net income for a conversion that honestly might never even happen. But in 2020, a landmark rule change, ASU 2020-06, finally fixed this. Now it's treated as a single unit of account carried entirely as debt. The interest expense you report is just the actual cash coupon paid, plus your standard issuance cost amortization. It's a massive, clean win for financial reporting that gives investors a much clearer picture of actual cash outflows.
But if you're an investor looking at earnings per share, there is a bit of a catch here. Post ASU 2020-06, you absolutely must use the if converted method to check if the instrument dilutes value. You basically have to pretend the note actually converted into shares on day one of the period. Let's walk through that math real quick. First, you adjust your numerator upward, meaning you add back that after-tax interest expense you wouldn't have paid if it was equity. Then, you adjust your denominator upward by adding all those hypothetical new shares. If that combined math drags your overall EPS down, the instrument is officially dilutive and you are required to report it that way. It ensures companies just can't hide potential dilution from their shareholders.
Moving on to part two. Warrants, the SPAC crisis.
Let's talk about warrants, which are essentially just the right to buy shares at a fixed price. A warrant seems simple enough, right? Often it's just issued as a sweetener alongside debt. But the million-dollar accounting question is always, does this warrant belong in the equity section or is it a liability? To safely live in the permanent equity section, a warrant has to pass two incredibly strict tests under ASC 81540. Think of these as very tightly guarded gates. First, it must be indexed exclusively to the company's own stock. No external variables or wildcards allowed. Second, the company must always unconditionally have the ability to settle the warrant by delivering shares, not net cash.
Now, if the warrant agreement fails either of those strict tests, it is immediately exiled from equity and slapped onto the balance sheet as a liability. And here is where it gets incredibly painful for a company. A liability classified warrant must be remeasured to fair value at every single balance sheet date. Every fluctuation flows directly through the income statement. Paradoxically, if your company absolutely crushes it and the stock price rockets upward, the liability of that warrant increases, so you end up reporting massive unrealized losses on your income statement just because you're succeeding. It is totally counterintuitive accounting magic that can make a wildly successful quarter look like a massive failure on paper.
To see the real-world stakes of this, we just have to look back at the 2019 and 2020 SPAC boom. Special purpose acquisition companies were raising billions, routinely issuing public warrants left and right. To save time, almost everyone basically copy-pasted the exact same standard law firm templates. But in April 2021, the SEC actually read the fine print. They noticed that in certain change of control scenarios, the settlement mechanics could actually change depending on who is holding the warrant, like an institutional investor versus a standard retail holder. Because the outcome depended on the identity of the holder, it wasn't truly indexed just to the company's stock. Boom, condition failed. Hundreds of SPACs were forced to restate their prior financial statements, shifting warrants from equity to liabilities and recording massive fair value changes they had previously completely ignored.
All right, part 3, handling non-controlling interests. So when a parent company doesn't own 100% of a subsidiary, how do we account for the equity that belongs to someone else? If a parent owns 80%, that remaining 20% is the non-controlling interest, or NCI. Under ASC 10 rules, that 20% must always sit permanently in the stockholders' equity section of the consolidated balance sheet. It is never classified as a liability. On the income statement, you present the full 100% of the subsidiary's net income, and then you explicitly carve out and allocate the NCI's rightful share so investors can see exactly what belongs to the parent and what belongs to outside partners.
The absolute boundary to watch here is control. Let's say the parent buys a little more of the subsidiary or sells a small piece, but still maintains overall control. Basically, as long as you are holding the steering wheel, it stays out of your earnings. It is strictly an equity transaction. You just adjust the NCI balance and additional paid-in capital. There is absolutely no gain or loss on the income statement. However, if the parent sells enough shares to actually lose control, the minute you hand over those keys, everything changes. The entire subsidiary is de-recognized from the books. You recognize the fair value of what you received, plus the fair value of any small stake you retained, calculate the difference against the carrying amount, and bam, that gain or loss hits your earnings immediately.
Part 4. Partnerships. Accounting without shares.
Let's cross over into the entirely distinct universe of partnerships and LLCs. Here, you basically have to throw out your corporate accounting textbook entirely because traditional share capital simply does not exist. There are no shares, no par value, no common stock account. Instead, when a partner joins, they contribute cash or property, and that fair market value becomes their initial capital account. From that day forward, this account is a living, breathing metric that represents their true economic interest. It grows when the partnership allocates them income, and it shrinks when they're allocated losses or when cash is distributed to them. The entire structure is governed purely by the operating agreement.
Now, how do you actually divide up those profits? In private equity and real estate, cash distributions usually follow a strict, sequential waterfall structure. Think of it like a series of cascading buckets that fill up one by one. First, the limited partners get their initial capital back, their principal. Next, they get a preferred return, say an 8% hurdle rate on their money. Once that bucket is full, the third step is a catch-up allocation to the general partner to help them reach their target share. Finally, any remaining profits are split in a predetermined ratio, often 80% to the limited partners and 20% to the general partner. That final 20% step to the general partner is known as carried interest. It's their performance allocation for a job well done. But accounting-wise, it's crucial to understand that this is not recorded as a standard salary or a bonus expense. At the fund level, it flows through purely as a capital allocation straight into the general partner's capital account. And by flowing through as a capital allocation rather than a traditional salary, it fundamentally changes how that wealth is taxed and tracked, which is a massive structuring benefit that investors care deeply about.
But navigating this universe is a fascinating web of complexity. Mostly because GAAP accounting rules and IRS tax rules diverge heavily here. Why? Well, GAAP wants to perfectly match revenues and expenses over time, while the IRS wants their cut based on real, tangible cash and specific tax code incentives. Because of this, GAAP depreciation and tax depreciation run at entirely different rates. You have built-in gains on contributed property to worry about under Section 704C, and recently, the IRS mandated that partnerships must report tax basis capital accounts on their Schedule K-1s. This means maintaining dedicated capital account ledgers and meticulously reconciling the GAAP and tax bases every single year is no longer optional. It is a strict requirement.
Finally, Part 5. Conclusion. Classification is king.
Bringing it all together, whether we're talking about convertibles, warrants, NCIs, or partnerships, the common thread tying this entire financial gray area together is classification. Your primary takeaway from this explainer is that getting classification right at the precise moment of issuance dictates everything. It dictates where the instrument lives on the balance sheet, how its value flows through the income statement, and ultimately, the company's entire financial narrative. You have to read the fine print of the agreement, perform a rigorous classification analysis, and document it before the books are closed. Skipping this step is exactly how those restatement disasters happen. Which leaves us with a high-stakes billion-dollar question to consider the next time you look at a corporate balance sheet. Given the sheer complexity of these hybrid instruments and all the tiny details buried deep in the fine print of the operating agreements, how many companies out there might currently have misclassified instruments quietly hiding in plain sight? Take a moment to think about that. Thank you so much for joining me for this explainer. Keep analyzing, and I'll see you next time.